I'm Bob Rosenberg. I'm a professor of entrepreneurship at the University of Chicago. And we are the partner with Cambridge University, who's doing the study of alternative finance in the Americas. That study will be done in October. I encourage you to come up and get more information from me after this, and we'd love to have you as part of the study. There was a bit of genius in making me the moderator. If you ever have an academic on the panel, always make them the moderator because it shuts them up. With that said, we have 4 terrific panelists, and what I thought I would do is I would have them introduce themselves and give you an anecdote from their business that would characterize what they do, who they do it for, and what is their advantage in the marketplace. Sam, why don't you start?
Okay, great. Well, Llewellyn's talking about cocktails, and Bob's talking about naps, so let's just jump right into auto finance. As far as an anecdote, show of hands, how many at some point in the past when you were shopping for a car would go on a Sunday when the dealership's closed, climb over the fence just so you could browse the inventory? Really, honestly, show of hands. Ever done that? Okay. How many have done that really in the last couple of years? It's gone to 0. People don't do that anymore. Shopping starts online. You ultimately end up at the dealership to purchase the car, but just think of that as the leap we are taking on the finance side, not just changing the experience for the consumer and the dealer, but also changing the whole process of ultimately bringing capital and liquidity into funding that business, and that's what DriverUp is doing as an online marketplace to bring auto loans as an investment to middle market investors.
Hi, my name is Hugh Bleemer. I'm CEO of PrimaHealth Credit. We're an elective healthcare financing company. Just to give you an example in terms of what we do, I'll use an example of a parent bringing their child to the orthodontist for braces. Goes into the orthodontist, the braces cost on average $6,000. And the family has dental or ortho insurance through their work, but it caps out at $1,500. So there's $4,500 that are needed in out-of-pocket expenses, and different ways to pay for that. Cash, you can use credit card, but the orthodontist has now the opportunity to offer a 0% interest loan to the parent of the patient. Usually, let's say 24 months in duration with equal monthly payments over that 24 months. So we are the provider of that product. The main way that we are able to make a loan like that and make some money doing it is that we charge a merchant discount to the orthodontist. So he pays or she pays us a fee in order to deliver that loan to the patient. Instant approval is done right over a smartphone or tablet right at the orthodontics office. And the loan is then billed automatically on a monthly basis, equal monthly installments. The segments that we are concentrating in, we're a very young company. We just launched in August. We're concentrating on dental, orthodontic, and vision, LASIK services to start. But we're then going to expand into cosmetic, audiology, and vet, and one near and dear to my heart, hair. So that's PrimaHealth Credit.
Yeah, great. We should talk. I think you hit 4 of the 5 expenses my family's had this month.
There you go.
So I'm Scott Harmon. I run Noesis. And so anecdote, I guess maybe a mini quiz. We just provided a loan to a tennis center in Ohio. And does anybody have a guess as to what the #1 operating expense is for an indoor tennis center? It's air conditioning and lighting. Thanks very much. 2/3 of the operating expense comes from heating the space and lighting the space. And this is a small business. They wanted to borrow money to improve their business by buying more energy efficient lights. Well, that's an equipment loan. It's different than working capital. It's different than unsecured credit. It's a secured loan, and they just could not get it. And Noesis was able to, through the use of our software, to analyze the savings that would result from purchasing that asset, combining that with the creditworthiness of the tennis center, was able to then provide a loan, an equipment lease, where basically the category we're in is in equipment finance, specialty leasing. But the difficulty, one of the many difficulties in equipment leasing is that you have to understand both the creditworthiness of the borrower and the business case of the equipment. And so we're able to combine those two things and to provide a very low-cost 4-year lease for those energy-efficient lights. The lights cost $100,000. They save $25,000 a year in utility bills. And so when you look at that, pick the picture of that tennis center, after they install those lights, they have much, much higher levels of cash flow, much better ratios, and so they become, as opposed to not being able to get a loan, they become a good candidate for a loan. So we originate loans in equipment spaces where the equipment needs to be analyzed side by side with the business.
Hi, my name is Arturo Aguilar with Auto One. We are in the auto business. You need to work with your channel, and it's one of the very unique particularities of the industry. And the further down you go on the sociodemographic segment, the more you need those things. So, as an anecdote, the first time we're canvassing through Hispanic communities to check out the dealers that were offering loans to people who don't have a FICO score, which is a shame because it's about 10% of the U.S. population. But well, the first visit I ever did, I remember walking into one of these dealerships, and the guy would tell me, after discussing soccer and bullfighting and things like that, he would tell me, so Arturo, why would I sell you my notes? And they hold their notes. They have $250,000 in notes, which they're financing with their own pockets or some weird financing on their own. Why would I sell you my notes if I'm not in trouble? Wow, I mean, let me explain, right? Unfortunately, it doesn't take that, it's not that simple for them. You need to explain that and you need to develop that channel. Eventually, what we realized that there was a phenomenal opportunity because once you develop a relationship with those guys, you have a wonderful flow of loans that are improperly priced, basically because there's no standard for them.
Great. So the emerging themes that I've been noticing through the morning have been the importance of technology, importance of service, the use of data, and some type of deep knowledge of the particular marketplace in which you're playing. As this marketplace evolves and matures, how will you maintain a competitive advantage against other entrants and perhaps larger entrants? Arturo, why don't you start?
Definitely. It's precisely because auto is dependent on channels. We have created a relationship with those channels, and eventually technology will catch up. And we are completely convinced that just as in more senior markets, you have dealer track that funnels all those loans to different kinds of finance suppliers. In this market, eventually technology will catch up. It's a matter of whether we provide the technology or we wait until somebody else does. So we're taking a page of the big guys. We're just actually, as opposed to the opposite, which I've seen throughout the day, we're taking a page of them and we're trying to develop portals and solutions that integrate with dealers so they can have alternatives of financing through us or somebody else.
Go ahead, Hugh.
I'll just piggyback on what you said, Arturo. So, in general, competitive advantage in a verticalized or specialized space, like I think everyone up here on the panel has, at least we think of it in 3 different dimensions. The first is channel. So, Arturo, you hit that right on the head. The second is product, being specific to the category you're in. And then the third is risk and underwriting credit strategy. So, to kind of expand on what Arturo said, we're in the equipment finance space. It's a very, very large space, but 60% of all the equipment financing is done through a vendor when you buy the equipment. When people buy the lights, for my example, They don't typically go buy lights from an industrial contractor and then go arrange a loan with a bank. They actually get financing attached to the sale like you would with a car or a consumer product. And so what that means is, in our world, I suspect it's true for everybody up here, is the channel becomes everything. And so we're actually a software company. Over half the people that work at Noesis are software engineers, and my background is actually more in software than finance. And so we've spent 3 years recruiting a channel and selling them our software to use when they propose a new sale. And so the entire front half of our product doesn't have anything to do with credit or pricing or risk. It has to do with making a sales proposal. And so we have now 250 partners who use us. They include names like Honeywell and Train, companies you've probably heard of. And they use our software to print out a sales proposal. The financing is then attached. 60 to 70% of the people don't necessarily shop. If you have a reasonably competitive offer, they'll take the financing. If they need financing, they'll tend to take it. So we call it white label financing. In other words, we're providing financing to a seller who then is really selling a product. The financing's embedded. I can't emphasize how durable we think that is from a competitive advantage. You recruit them, they use our software, we train their users. We have 900 salespeople that sell lights and air conditioning that use our software and go through training. So when the competition comes, which it inevitably will, that's one dimension of competitive differentiation that we feel pretty good about.
I'll comment on our industry. It's a platform and product. So just, again, we are providing consumer loans through a doctor's office. So today, a lot of human interaction, actually quite a bit of paperwork, and a hard copy of signatures still occurs today with some of our competitors. So our platform has, eliminated that paper and has also allowed the transaction to occur with a minimum of human interaction involved. And again, to keep on evolving on that platform to make sure that it's compliant, staying ahead of the regulation that's out there in consumer lending, and making sure that you're always a couple steps ahead. On product, it is just, in terms of, again, we're a niche player in a market that is the product evolves, and providers are looking for different terms. They're looking at different populations. They're even willing to take on some of the risk themselves, and it's working with them to decide who's going to take the risk on the loans that we provide. So it is, just to build upon what's been saying, platform is key from a regulatory standpoint and ease of use standpoint, and product is really just having the knowledge of the channel that you're playing in, and have that relationship and knowledge that's a step ahead of your competitors.
Well, when we think of how do you stay ahead of competitors, I think just the global generic answer that applies to every industry applies, and that is, how are you solving a problem? How are you meeting a need? And we look at the needs that we're meeting for three specific customers. We have marketplace investor customers, dealer customers, and consumer customers. For investors, we're very simply looking to bring a higher yielding asset in the fixed income market in a low yield environment that's not correlated with other assets, that is a mechanism to make a direct investment in auto loans when, for the most part, the only mechanism was the securitization market that was limited to more established entrenched institutions. So we want to really make that available to the middle market investor, and we feel like we've done that successfully so far and moved first and met that need. When you look at dealers and consumers, ultimately a dealer wants to sell a car, a consumer wants reliable transportation and wants to have a fairly decent financing experience. Arturo mentioned zero FICO customers. I mean, we see some of those, and the FICO score, it's one of the best kept secrets on the planet. I mean, it's better kept secret than the formula for Coke. I mean, no one really knows what's in the FICO score, but there are some consumers that don't deserve a FICO score because they just don't have any established credit. There's some consumers that have 2 or 3 or 4 trade lines. There's something just quirky on that report that didn't allow a FICO to generate. And our custom scoring model allows for a zero FICO customer to be scored just like anyone else and look at the likelihood of how they're going to perform on an auto loan. So that brings a competitive advantage for us and lets us go into dealers and consumers and say, don't worry about your FICO, find the car you want. We're going to help make that affordable, make the decision as quick and as using our technology to make that a better experience for everyone.
So all four of you raised what for me is sort of music to my ears because it's words that didn't get captured in the rest of the conference. Are there venture or private equity guys here? Hands? A few? Technology is good and service is good and being aware of regulatory is good, but what about customer acquisition cost? I mean, if I look at this sector in the industry today, customer acquisition cost is skyrocketing. How do you plan to expand your business and manage customer acquisition cost? Sam, let's start with you.
Well, that is a great question, and it is interesting. The traditional model of auto finance, spanning the last 20 years, looking back, has involved a working relationship with a dealer, marketing cost, and then cost involving credit investigation, underwriting, funding, and then ultimately closing that loan. And looking at all those components and all the work that goes into that number has actually been fairly stable, but it's not something that we are just going to sit back and relax and say it's not going to go up. There's not going to be any problems. We're constantly working at using our technology to make the decision quicker, to use things that aren't asset heavy, that aren't fixed cost heavy, where we can make the decision process something where we're using our software and our technology to make that happen. If we find pockets though of the market areas where we just feel like it's not going to be cost effective, that's something that we're going to leave to someone else. Like new car financing, for example, the captives are very aggressive at moving their cars because they have a vested interest in doing that. That may not necessarily produce an investment asset as an auto loan that someone wants. So we would say that that's a segment that we might not be as heavily focused on. But the much larger side, the used car side of the business, is where we concentrate our efforts and continue to use the technology to make the cost or keep the cost reasonable and as low as possible.
For us, acquisition costs, they're expensive. A big part of our budget is going towards marketing and acquiring, and again we're going after providers. Even though we're a consumer lender, we don't market directly to consumers, so we're bringing the providers into our network. Different ways to reach them, some very traditional ways, trade show, some social and internet advertising, direct mail, etc. I mean, all the usual suspects of channels in terms of bringing them in. I'd say the one thing that has been to our advantage in bringing some costs down is partnering with other sales forces. So there are salespeople that go into doctors' offices all day long. Many of them are manufacturers' reps. So again, we have an inside sales force. Manufacturers usually have a combination of inside and outside, and partnering with them and figuring out compensations, spiffs, etc., in terms of leveraging one another's sales force and talking about multiple products at the same time. All has its challenges and needs quite a bit of time to set up. However, we have experience doing it in a prior company, and so we know that alliances with different sales forces works, and being very selective and concentrating on products within where we want to play, we have dramatically lowered acquisition costs for some of the providers we're bringing on. But I just want to start with my original point too, is that you really, acquisition is it's an expensive, a process, and you need to budget for it in terms of building up your network or whatever network you're trying to build up.
Hugh, how do you make what is basically a belly-to-belly business sticky? That sounded all wrong.
Say that again now?
How do you make it sticky? How do it's easier to keep a customer than to go find a new one.
Yeah, sure. So, well, for us, it comes down to service and approvals. So again, we're a young company building a network, and so that's why maybe I'm coming at it as we have a lot of our dollars, in terms of acquisition. We're in the midst of building our network. In terms of keeping that network or keeping the providers using you, what it comes down to is the ease of use of the platform that we have, the approval rate in terms of are there patients getting approved for a loan, and and the service that we're providing in terms of are we funding loans and are we delivering what we need to deliver. So it's execution, and yes, you don't want to lose a provider, but again, in our business, they come in and out. It's a constant battle in terms of activation and making sure that they want, that we're the preferred company they want to use. But we think that we have the platform and tools to keep somebody engaged because we are just so easy to use, and we just, to your point, we have custom scorecards as well by the segment that we play in. So we think that our approval rate can compete with and beat anybody out there.
Good. Scott, go ahead.
Yeah, so, I think this is very much just a common issue is acquisition costs. In the unit economics, when you evaluate lending models, I've heard it go anywhere from 3% to 10%, or if not higher, of a loan. But, given that we're in a business vertical, and particularly our sale, because these are large loans, again, most of the equipment we finance would be between $30,000 all the way up to $1 million. These are not consumers' sales, these are business-to-business sales. And some people may take 2 or 3 or even 4 or 5 months to make a decision to buy this equipment. So it's a very personal sale. We actually took a pretty different approach to acquisition costs. We don't pay for loans. Our partners actually have to pay us an annual subscription to use our system. They pay between $5,000 and $50,000 a year to be in our network, to use our financing, but more specifically to use our software tools. And I think what we've seen is our software tools to them are so valuable, and back to your point of sticky, that sometimes our partners don't know whether we're a software company for sales tools or a financing company. And so there's a lot of value add if you can sort of get inside the sales process of a B2B sale. You're very deeply embedded. It's very, very hard to sort of pull you out. So unlike sort of point of sale consumer financing, in a B2B relationship, if you're deeply embedded with the sales team and they use your software, and critically they pay us, we actually have a negative acquisition cost. Because again, we have this money coming in from partners. And so right now we sort of make, sort of net a point or two from the partners who send us the loans. So it's because we focus so much on such a tricky sales process, and we build the software.
I think that auto and equipment financing have a common thread, which is there's a channel that you need to cater to. So I wonder, of course, there is an acquisition cost, but I wonder whether the better issue would be how do you make sure that once you capture that channel, it becomes yours? It has to do with just focus and understanding how it works. The beauty of a loan that has to do with an intermediary who works with you on volume is that the acquisition cost happens once typically, and after that you just they're actually willing to pay for that service. We've seen it in Dealer Track where they actually do it through, they pay the intermediary, and I'm sure we could see it also in how we see it, how they price those loans to us compared to the competition. Once they have a relationship, they don't want to switch. It's we end up getting point or two above or below, I guess, in discount to our competitors. So I guess we're in a very unique segment of loans, all of us here, I think, that might benefit from that. There's a relationship to the volume provider of these notes.
So if I'd interpret the comments of this morning, I would come away thinking that the kind of niche financing you provide is not a sustainable business model. And I want to know your thoughts about it, and whether you need to be thinking about additional products or expanding your base. And let's start with Scott. Scott, let me know what you think about that.
Sure. So, we think of ourselves as, we call ourselves a vertical lender. So again, very specialized along the dimensions that I've mentioned. We are specialized in a specialized vertical of a very, very large segment. Equipment finance is, by some measures, $300 billion a year or more. It's exceptionally large. People finance airplanes and trains and cooking equipment and all kinds of, most capital equipment is financed, not purchased on the balance sheet. So there are somewhere between 10 and 15 verticals of equipment finance, all of which are 30 billion or more in sales a year. We're in one of them, which is an industrial equipment for building, but there are many, many other verticals that have exactly the same dynamics of what I just described. A very specialized sales force. Most of the financing is acquired as part of the product sale, as opposed to sort of a separate aftermarket, and a unique product structure that's tailored to the equipment being financed. So right now, we're a venture finance company, and so as we raise venture capital, we use that venture capital to sort of add additional verticals. And so while we're focused on financing assets that generate energy efficiency, for us, it's probably the first of multiple segments we'll do in the next couple of years. The key for us is finding segments where the business is a better business once it purchases that equipment. It's a better it performs better. Most equipment is financed for one of two reasons: it drives revenue or it cuts expenses. That's for the most part why people buy equipment. And so our focus in picking verticals is, does it really make the business better? And so we're in the process, and I think we're going to have to do that to make sure we can keep growing the business and stay differentiated.
Arturo.
Yeah, I think that your question about whether we need to offer more products or not, and whether the margins are eventually going to get crushed, I think it's the horizon that matters. Eventually, yes. I think unless you have your own balance sheet, which is, I think, the opposite of what the industry is seeing, if somebody's going to be providing the balance sheet and somebody's going to be doing the marketing and the analytics, which is what we've been seeing lately, for the last few years, then of course you need to specialize on the segments that you like, and eventually either partner or merge or something with the bigger players who can specialize on the balance sheet side of the business. So short answer, yes, I do believe we will have to explore new products, and you get to know a market. For us, it's a Hispanic market, so if you can offer them a car loan, you can interact. Just think all the possibilities of 10% of the population that does not show on FICO. Anything you can imagine. But eventually, the balance sheet, I hope, will belong to somebody else.
Hugh.
Today, with elective healthcare spending, it's $87 billion, growing every year. Only 20% is financed. We have a wide open opportunity for us in terms of growing into the space. So, for the next couple of years, we see plenty of opportunity in terms of that space. However, what I will throw in is, though, playing in the healthcare space, there is just so much change going on in healthcare between, hospitals, insurance companies, doctors, et cetera, the Affordable Health Care Act. So we've identified a number of places where there are opportunities for consumer lending in the healthcare space that is beyond elective healthcare. And we're looking at them now, learning about them, studying them, so seeing which ones are going to be, where we have the most opportunity to play. But with our platform is customized towards the, the medical space. There is just tremendous change going on there. There are a number of opportunities for us to grow beyond elective healthcare, but we're satisfied for now, and we'll see what the next couple of years bring.
Sam.
On the marketplace investor side, we are targeting a 7 to 8% all-in yield to investors. That's what we're looking to deliver, and that's an asset that's, as I mentioned earlier, not correlated with other fixed income alternatives. And if we're able to do that, unless interest rates go up globally, 5, 6, 7%, that's sustainable. That's meeting a need. That's a fixed income opportunity that I don't see going away, and we're confident we're going to deliver that. We've done case studies with securitizations in past markets, past cycles, actually unbundled all of those loans and seen similar results if you were actually just buying the auto loans underneath the bonds. So that's something we feel is sustainable. On the consumer side, I know it's hard to talk about auto loans and picking out cars when you're in New York City, when you have such good public transportation, but everywhere else in the country, you have to have a car. You cannot get around without a car, and the auto finance market is right around $1 trillion of total auto loans and leases outstanding. And there's no plans to build big subways and in the Midwest, certainly in Dallas there's not. So we feel like just meeting that need for the consumer and financing consumer products, again, if you are focused on the credit quality, on the performance and your cost, that's a business that we can stay specialized in and continue to use our technology to improve the service, improve the experience, and stay a step ahead of everybody.
In 3 words or less, starting with Sam, what is on the horizon that sobers you or excites you about this marketplace?
3 words. Electronic signature. That's 2.
That's good. You don't need 3 words or less. 2 is good.
Baby boomers.
3 words, boy, that's really constraining. On the sobering side, I think anybody would be probably lying if they didn't say credit cycles. There's credit cycles are credit cycles.
Very good. You get a gold star.
Yeah, so good. One word left.
I guess consolidation. That's on the plus, that excites. On the down, weird regulation. We're good for regulation, just not for weird regulation.
Any questions from the audience? Okay, please. Okay, go ahead.
Mostly on the auto side. Sam, and I guess Arturo, but who would you see as your competition in the marketplace lending sort of space? You're obviously a leader, but who's following you?
Well, at the present time, we see the competition as more of the more established unsecured consumer lenders, small business lenders, lenders that are offering other non-auto types of products to investors. From a standpoint of someone else that we see doing it strictly in auto, we just haven't really seen much of anyone doing it. That's why we think we're really uniquely positioned to be focused just on auto and continue to really refine that product.
Any of the big guys who are willing to understand the niche, if they understand their numbers, they have the resources to come in.
Yes?
How do the models change as interest rates, assuming they ever go up, as interest rates normalize?
Good question. Did everyone hear that question?
Maybe you can just restate.
Okay, how do the business models change when we leave this sort of golden era of no interest rates and the interest rates begin to go up? Which one of you would like to?
We happen to be in a niche of people who do not have a FICO score and are willing to take the necessary steps to become to become a regular credit subject. So we will still be in the highest level of rates. So we're relatively cushioned there.
Others?
Yeah, we're probably a little bit at the other end. Most of the loans that come through our platform and a lot of equipment leasing and financing in particular is right now quite high quality. Usually single digit kind of APRs are attached to most of these loans. And so what you have is a lot of lenders being actually really super selective with very tight credit windows and, you know, sort of. So one of the things that marketplace lending and platform lending in general and approaches like ours do is allow us to sort of expand that spectrum of products and risks a little more. The reason we want to do that is so that we're not tied to any one particular sort of, you know, peg in the credit, you know, the credit spectrum. So if we're able to sort of expand the credit spectrum we're loaning across, then we'll have a business that's pretty flexible as those things move up and down. We're not a balance sheet lender, so we're not particularly opposed to credit spreads. We really just have to make sure we can place our loans at the right cost of capital and make sure we just have enough variety that we can always adjust as the interest rate environment adjusts.
The only thing I'll toss in is with us in terms of the rates that we charge consumers, we even see in a rising rate environment, our rates will not move that much in terms of what we're charging consumers. However, that merchant discount that go to providers will move as interest rates move.
So I think it's really a core issue. I you know, as an academic, I'd say that's the sort of elephant in the room that people aren't speaking to right now, and that I think that if you're an investor in this segment, has got to concern you. One last question? Yes.
Here we are at a financing conference, and the words credit cycle just came up. Question for all the panelists. How are you thinking about the adequacy of the rates you're charging to absorb future credit losses whenever the cycle does turn?
I'll answer just from my perspective is that having, you know, been a consumer lending and lived through the last cycle, to me, no matter what you're going to add on in terms of interest rates, at least for consumer lending, will never replace, or you'll never be whole with if your loss rates are spiking. It doesn't matter how much you charge the good guys, you'll never make up for the bad stuff that's not being paid. So for me, it's really having, you know, the scorecards and the risk team working those scorecards that is watching it daily, if not hourly, in terms of what's going on with repayments, what's going on with people's, you know, how's unemployment, what's the macroeconomics looking like, and how are, you know, first payment defaults. I mean, literally looking at what risk people need to look at every day, because that next cycle's out there. No one's going to be able to predict exactly when it comes, but if you're not seeing it 14 to 16 months before it comes, you're not going to be around after the cycle.
So I definitely agree. I mean, some of these things, obviously, you just can't get away. You have to manage around them. But there, in our class in particular, there's two things that tend to mitigate somewhat against those cycles. The first is collateral, and then the second is just sort of where you sit in the business's focus of having to pay the loan. I mean, so we're not an unsecured lender. They pay their loans because they need the equipment, or they don't want you to come and repossess it. And so the more you can get into having a business critical collateral back, you know, piece of collateral that you sort of tend to sit a little higher when things tighten. So that at least helps our picture somewhat.
The other component of the down cycle is getting the markets dried up. My take is that eventually, if you control properly for losses and you create right reserves, the complementary component is that you need to keep a balance sheet. I think most of the auto lenders that are there trying to do something on the market space, we're all trying to keep a balance sheet as well. There's a safety in those kind of numbers rather than just living by the cycle itself.
Please join me in thanking this terrific panel.